Well, welcome to this week's edition of Thank God It's Friday. We have a very important event lined up for the week ahead. That's the US Fed meeting that I'm talking about. And we have here with us Jonathan Schiessl, CIO at Ashburton Investments, who joins us to give us a view, a FI view on Indian markets and the implications of the likely Fed action on our markets, of course. Jonathan, hi, wish you a very good afternoon. Thank you so much for speaking with us. What are the key things that you're going to be watching out for from the Fed meeting and Janet Yellen's commentary?
I think obviously markets globally, as well as in India, emerging markets have been eagerly awaiting this event. You could argue certainly markets have priced in some sort of interest rate rise. I think I think certainly the street is expecting a rise to come through, so that will not be a surprise. I guess looking from an emerging market perspective, the scale of the rise will be important. We're not expecting anything too dramatic, but clearly that how big a rise it is and the commentary that comes with it is obviously always the key part. Obviously working out the trajectory, how many more rises, etc., etc. So that's clearly going to be very significant for emerging markets and the implications for emerging market currency, bond markets, etc., etc., depending on those interest rate differentials.
Okay, I believe markets have already started pricing in 2 hikes in 2017. 2016 is a given, it's done and over. 2017 is what people are looking at. Instead of 2 hikes that most of the street participants are really talking about, what if Yellen hints at just a single hike or 3 hikes? How does that change things for the markets, global and Indian?
Yeah, I think that's a very valid question. So I think the key question really is, it's very difficult for anybody to work out what the outlook will be. Sure, Yellen's just looking at the economy, but obviously with the President-elect Trump and when he actually takes over the White House and we need to see what his policies are. Are they going to dramatically alter the US growth trajectory? If he does get some of this offshore US money back in, and if he does have policy in place that ensures that money actually gets into the real economy and from companies that will actually spend money on new productive facilities, etc., etc., then clearly that will change ultimately in the medium term the outlook for US interest rate policy. So there is a huge amount of uncertainty out there. So I would expect conservatism initially from Yellen until we're all grappling with what does actually Trump stand for and what is his policy going to be, because it will have an impact on the US and therefore on the globe.
So, we've been reading a lot about Donald Trump looking to increase exports from the United States, but that will also mean a weakened dollar going ahead. Should the dollar weaken, say, over the next year, what does it mean for emerging markets, and how does China then stand as against India if we see a weakening dollar in say, next year?
Yeah, I mean, clearly it's interesting. We've seen a bit of a breakdown in the relationship of dollar, the dollar versus, for example, commodities versus energy. That's been sort of changing over the last month or two, ever since Trump's come in place. And traditionally, as we all know, strong dollar was never great for emerging markets. Now, clearly, again, if Trump ultimately can get the US economy on a stronger growth trajectory than most analysts or forecasters are predicting, the first sort of conclusion from that would be great for emerging markets, because ultimately, particularly for an economy like China, China needs US domestic consumption to suck up its exports. So it's less, I think, relevant for India, because obviously India does not have the same export structure. Exporting goods to the US is obviously more of a services function India has. So I think it's very different, and I think there's also, it's important that, is the dollar, a strong dollar going to, a strong dollar, weak dollar? We're all a bit uncertain about the direction of the dollar. Our view remains that we think the dollar probably has a little bit further to go, but the bulk of the move has happened. But we could easily, very easily see quite a shift in trading patterns in the period ahead. So net for us, I think probably one of the key relationships going forward will be to examine that relationship between China and the US, because I think it's quite obvious at the moment, if you look at the changes going on in China, if you look at this growth slowdown going on in China, if you look at the overcapacity amongst several sectors of their economy, then quite frankly, China needs the US than the US needs China, in our opinion, needs more of the US. So therefore, I think there is some justification for Trump in trying to rechange that relationship going forward. But India, I think India is very well placed to cope with what we've seen with this strong dollar so far. But clearly, from a trading perspective, it's a very different proposition when you look at India versus China, because it's more of a services type story as opposed to an export of goods.
Okay, so if you consider the impact of demonetization on India, have you tempered your earnings down by any chance? What are your expectations from financial year 17, and what is your outlook on financial year 18?
Yeah, so clearly, is it going to be 1, 2, 3 quarters of a hit to earnings? We haven't yet fully modeled through the impact. I think it was interesting to look at the Reserve Bank of India's comments earlier on this week about, and I think they're being somewhat too bullish, for example, on the impact of demonetization to Indian growth. So I think for us, it's just a little bit early to rip up our expectations of where earnings are going, and certainly for the rest of this year and next year as well, because there is a lot of uncertainty still out there, and we just don't know. But what we do know is clearly it has been a fairly significant hit in the very short term. We're hearing some parts of the economy are getting back to recovering. They're certainly not back to normal, but there is some recovery in certain sectors. So we haven't, as I said, yet ripped up our numbers just yet, but we tend to try and look at least 2 or 3 years out. And so from that perspective, we think the story hasn't really changed a great deal. Obviously the hit, though, is to that more short-term numbers.
All right. Foreign institutional investors have been net sellers of Indian equities for the most of November. However, we have seen some small buying that has been trickling in the last 3 to 4 sessions. What do you think could have led to that reversal? Is there any change in perception as far as foreign investors are concerned?
I don't think so. I think we read a lot of reports suggesting great policy demonetization but bad implementation. I think that's somewhat unfair, but anyway, there is a lot of that. I think clearly what has changed is valuation. Whilst the market certainly hasn't got back down to what I would classify as cheap levels, there's certainly some individual counters that have, particularly in the mid-cap and small-cap space, where you've seen quite profound deratings in a very short period of time. But mainline indices, they've come off a fair way, particularly when if you're looking at it in dollar terms as well. The rupees, had depreciated quite significantly. Indices had come off, so looking at the India in dollar terms, it was looking reasonable valuation again. And then again, it comes back to it. If you look at the emerging market space, which is the economy which is genuinely, has fantastic growth opportunities going forward with a reform-minded government. And certainly India tends to sort of stack up on those fronts. So I think because valuations have come down, again, particularly looking at it in dollar terms, the reason money's selectively begun to come back in is because we're finding certain pockets of value again.
All right. Does the Indian government's surprise move on black money really bring in more confidence in the government's intention to really deal with corruption and bureaucracy, something which is very common as far as emerging markets are concerned? And do you think this will have implications for the country's credit rating in any ways?
I think anything, I think most foreign investors, certainly we speak to, and we were taking, when I was in India a couple of weeks back with some major investors into the country, and that most of them have come away with quite a positive impression about what they're what was being trying to achieve with demonetization. Ultimately, I think, if you just step back and move slightly away from the short-term noise, which, that can be very painful, that short-term noise for certain parts of the economy. But I think ultimately, if you step back, and if this move actually does encourage the growth of the formal economy versus the informal economy, then that's great news for an equity investor, because after all, you are investing in that formal side of the economy. So therefore, the companies within that have a greater opportunity to grow earnings ultimately over the medium to longer term view. So I think it is being viewed positively on that front. And then secondly, obviously, it will, if it does help the formal financial system grow and more people start getting involvement with that formal financial system, then ultimately it will help government tax take, etc., etc. So I think overall, again, whilst there's been questions about implementation, certainly most people I speak to, and I would agree that this is a positive move, and from a governance perspective, it is certainly being taken as a positive move.
Okay, Jonathan, your India fund has Tata Motors and Eicher Motors. You guys are invested in it, and you were in India just a couple of weeks ago. What is your reading of the impact of demonetization on these two companies? And I ask because we haven't really seen a substantial correction on either of these companies. And how much of this has to do with the fact that a lot of these vehicles are financed and not transacted on cash?
So I think, well, just first of all, Tata Motors, clearly the biggest driver of Tata Motors is Jaguar Land Rover, which has, obviously very little to do with the India growth story. So obviously that stock has other issues from a governance perspective with the spat going on between, Ratan Tata and obviously Mr. Mistry. So I think demonetization clearly doesn't have much of an impact on Tata Motors. Yes, it can hurt their CV business and their domestic car business, but really the story with that stock is external. So we move that one to one side, and clearly when I was in India, I did meet some senior management from Eicher Motors, and at the time they were saying quite clearly that yes, there had been a marginal impact to Royal Enfield, the Royal Enfield side of the business, which again is the main driver of that business today. Yes, they have a large commercial vehicles side, which probably was getting hit more. But it's been interesting to note that subsequent information from the company would sort of bear that early assessment out, that actually most people who are buying Royal Enfield bikes tend to be from the salaried classes, so from government employees or from the formal economy. So and obviously as you rightly say, there's a lot of these bikes are bought on credit, or actually a lot of people who from the formal sector pay for their bikes are actually paying via bank accounts. So there's no issue there. And obviously it helps they had a long waiting list as well. So I think the impact for certainly Royal Enfield has been quite transitory, and we wouldn't, we were quite confident after speaking with management in the very early days that particular company wasn't going to be hit too hard. I think clearly there's more pain to be felt in other segments of the two-wheeler market, the smaller, CC motorbikes and the scooter market, where there is more of a cash element. But no, so from Tata Motors and Eicher Motors, the impact isn't too substantial.
Okay, and are you really concerned about the growth in the Indian IT industry? I know that you're invested in Infosys again, but do large IT firms have the flexibility to adapt to the changing environment and the new requirements that is needed for that kind of growth? And if yes, do current prices offer value?
So we've been adding to IT stocks over the last day or so. I think these companies have shown that in the past they can adapt to change. So I wouldn't be too worried about that. But I think clearly, if you look at the valuations and the prices of the large Indian IT players, there has been quite a profound derating over the last few months. So we've begun to see real value emerging back in these particular counters. We're not saying these things are going to scream up anytime tomorrow, but a lot of them are very cash-rich companies. They're obviously benefiting from this falling rupee rate, and ultimately we do believe the bigger, better companies actually can cope with a changing business model. Our view would also be that we're not sure America is going to launch a major trade war with India on IT and outsourcing as such just yet. So I think there has been a lot of negativity, priced into share prices, and we see value. And we do also think it's interesting to note that obviously Cognizant, one of the large competitors of the Indian IT space, have just had an active shareholder on their register appear, who's trying to encourage the company to A, be more operationally efficient, and B, to use its cash pile for the benefit of shareholders. So we think that also is going to be a trend in the Indian IT sector, and obviously the likes of Infosys and some of the other IT majors are sitting on substantial cash piles, and we think they will actually start managing those cash piles better going forward as well.
All right. How are you viewing, or what is your stance on the Indian pharmaceutical companies, especially in the backdrop of Trump's recent statements on bringing down drug prices in the US? Two of your fund holdings, Sun Pharmaceutical Industries and Lupin, both have a sizable exposure to the US markets, and they've already been seeing single-digit price erosion in their portfolio. So, as an investor, does Trump's statement really worry you?
I think it's inevitable, with his statement, and even in the UK, obviously there's been a legal case against a large American pharmaceutical company whereby they've been accused of overcharging. I think there is a trend amongst developed markets to look at drugs pricing, and I think that trend will carry on. Ultimately, that should benefit a lot of the generic manufacturers, where India obviously is very strong in, from a demand perspective, but certainly from a pricing perspective, I think that's the world we live in now, and there will be a lot of noise, if you like, from governments all across the developed markets to try and deal with their massive budgets that they face and the costs they face with an aging population. They need to get drug pricing under control, so this is an area where we expect continued noise, if you like, for a long time to come. So those companies which, ultimately it does benefit, to our mind, the generic space, but it means that probably some of the drug pricing and some of the profits we've seen in single drug lines in the past, it's going to be difficult. We wouldn't expect to see that in the future. We actually did increase some of our weightings just prior to the US election into that space, because we felt again some of the concerns over a possible Clinton victory were getting more than priced into share prices. We are still very underweight the sector, however, but we do, as you rightly say, have exposure via obviously two names, and we just feel valuations have been coming back into the pocket again there as well.
Okay. How would you rate India's performance in the year almost gone by now, 2016? And if you could share with us your outlook for India for 2017.
Yeah, clearly India's underperformed other emerging markets this year. It's had its moments, but I think a lot of developed market investors have not been in emerging markets at all over the last 4 to 5 years. Some developed market investors bought the sort of India growth story under Modi, and certainly India, when you compare India to developed markets, it has been, obviously on a 3-year view, has been outperforming. I think though what you've seen is, as you've seen this rise in energy and commodity prices this year, it's encouraged people to go back into the really beaten down emerging markets, like the Brazils and the Russias, and some money has naturally drifted out of India. I think next year that probably will be a slightly different story. Our view would be that the commodity price rises that we've seen due to Chinese stimulus policy, due to hopes about Trump obviously initiating a new infrastructure push and infrastructure spend. To our mind, a lot of that good news is in commodity prices as they stand today. We're not expecting an imminent collapse in commodity prices, but a lot of good news is in the price. So I think next year investors will have to get slightly more, it won't be quite such an easy trade to go into these cheaper commodity-related emerging markets. So I think clearly for India, the outlook for next year will depend, A, on the elections, the state elections we've got in the first quarter. It'll depend on GST and its implementation. I think India could actually surprise next year, again, because the market's come off fairly substantially. I think we're not expecting India to race away anytime soon, because there still is that uncertainty about the effects of demonetisation. But I think at current valuations, for a slightly longer term view, with what is going on the ground, with some potentially, if those election results come through reasonably positively, then India could do quite well next year.
Well, it's going to be yet another eventful week coming in, and I'm sure our conversation with Jonathan has given you some perspective. Thank you, Jonathan, for joining us and helping us through a lot of those questions. And as for you guys, whoever's come in late, well, you guys can always tune in the social media and follow us on Twitter and Facebook, and get a rerun of this conversation that we've had with Jonathan. And if you want to have, of course, another read, you can always come back and tune into BloombergQuint.com. But that is all that we have for this edition of Thank God It's Friday. Until next week, it is goodbye.